How's it going, Dividend Nation? Welcome back to another video. With the holidays, a lot of folks find themselves coming across some extra cash. Maybe you received a sweet holiday bonus or got a hefty chunk of change for the holidays. When I get extra cash, I like to buy dividend stocks. What better way to put extra money to use than to have that extra money generate you more extra money? It's pretty amazing. Now, maybe dividend investing is something you have an interest in, but aren't quite sure how to get started. And today, I'm going to show you how I would build out a new starter dividend growth portfolio with a chunk of cash for the year 2023. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor, just a guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could please do me a favor and smash the like button and subscribe to keep up with future videos, this helps us out more than you could imagine in bringing you quality dividend investing content. Also, my friends, I had a goal of hitting 4,000 subs before the end of 2022. We smashed that goal already, and folks, we are now over 5,000 subs and climbing. I'm blown away and appreciate all the support. We have some exciting stuff coming in 2023 and happy to have you along for the journey. So let's say you've got a chunk of money for starting a portfolio. You want to get started with dividend investing. Say you have $1,000. Now, if I'm starting from scratch, I would take that $1,000 and split it between 10 different types of stocks. The goal is to capture multiple sectors in the market and spread the risk around and not be too concentrated on one stock or sector. For a new portfolio, I'm going to stick with high-quality companies with solid financials and track records. I highly prefer to invest in companies that I use myself. I think this is a great way for new investors to get started by sticking with the products and services that they use in our daily lives. This keeps it to businesses that we understand. I look for moats. I want a dividend that is easily covered by free cash flow with room to continue growth, and I want to see a nice track record of dividend raises. As I'm not using this income now, I'm really more interested in the total growth and compounding. So the dividend yield itself is really not that high of a consideration for me. I'd like to see the yield of a portfolio like this be, somewhere around 2.5 to 3%. If I was looking for current income and I had larger sum of money, I would be building a different portfolio than what I'm doing here right now. This portfolio I'm talking about is, say, for a 10 plus year time frame, 10, 20 years. Of course, index funds and ETFs are another great option, especially for getting started. Now, if I had no money invested at all, knowing what I know, I would likely put my first $10,000 or so straight up in an S&P 500 index or total stock market fund, think like VOO or VTI. But for this video, I'm going to assume that we want to stick with individual stocks and that we are looking to build a growing stream of passing income with as little risk as possible. So with the $1,000 or $10,000 or whatever amount it is, doesn't really matter. What I would do is I would divide the money between 10 stocks across several industries. So first, I'm going to go with one of the mega cap tech stocks, either Apple, ticker AAPL, or Microsoft, ticker MSFT. These are the two largest companies in the world by market cap, and they both happen to pay a small but growing dividend. I think every investor ought to have some exposure to one or both of these companies. Not really a heavy preference towards either. I'm a big fan of both and I own both myself. So that's $100 into either Apple or Microsoft. And second, I want to get exposure to the healthcare sector. And I would strongly prefer we go with Johnson & Johnson, ticker J&J. This is another one that should be a foundational core stock. Both Microsoft and J&J have the distinction of being the only two companies with a pristine AAA credit rating, which is better than that of the United States government. With J&J, you're getting the pharmaceutical business, the medical device business, and its consumer goods business. Now, the consumer goods business will be spinning off in 2023 under the name Kenvue. These are products that you certainly have in your house right now, such as Band-Aids and Benadryl. So that's $100 into J&J. So we got tech, we got healthcare. For the third pick, let's go with some consumer staples. I'm going to put $100 of my that $1,000 into a company like Procter & Gamble or PepsiCo or Coca-Cola. These companies all profile very similar, so pick the one you like best. All three, just like Johnson & Johnson, have Dividend King status, paying a growing dividend year after year for 50 years. If I was forced to pick a favorite out of these three, it would be Pepsi. All three of these companies do trade at a little premium. They're more expensive. You are paying for quality and reliability. Consumer staples are one of the best sectors for reliable dividend payers. Now for my fourth pick, I'm going to go with a retailer. I'd take $100 out of my $1,000 and put it in a company like Kroger or Target. If you're a coffee drinker, maybe you could go with Starbucks as the world's largest coffee retailer. There's a lot of options, but I would start with one of these three. All three have solid dividend growth track records. Retail just makes too much sense, especially under the prospect of a recession. Folks are still going to buy their coffee. They're still going to need to buy the types of products sold at a grocery retailer like Kroger. For the fifth pick, I'm going to stay with retail, but in the home improvement sector. I'd like to have one of either Home Depot, ticker HD, or Lowe's, ticker LOW. These companies profile very similar. Lowe's has the longest track record as a dividend king, increasing its dividend for over 60 years. But Home Depot is the larger company out of the two. At the time of publishing, I think Lowe's looks a little more compelling in terms of value, but can't really go wrong either way. Both companies have a 5-year average annual dividend growth rate of 18% and have trounced the S&P 500 over the long term. So I want to stick with one of these two companies for my fifth pick. It's 5 down, 5 to go. For the sixth pick, I want to look at the industrial sector. I would pick either Union Pacific Railroads or Waste Management. There are a lot of high-quality companies in this sector that are great for dividend growth investors, but I like one of these two the best. Both have an impressive moat. With Union Pacific, you're getting 32,000 miles of tracks across the western two-thirds of America, and they are sort of in a duopoly with Berkshire Hathaway's railroad. And then Waste Management. It's hard to see a world without waste management. It would be quite a mess, but thankfully we have them to deal with our waste, and they pay a growing dividend. I almost see them as like a utility in a sense. So for the seventh pick, let's move along to the financial sector. Who do you bank with? The two largest in the U.S. are JP Morgan Chase, ticker JPM, and Bank of America, ticker BAC. Now maybe you want to go with some international exposure here. You could pick a Canadian bank like TD Bank, ticker TD, or Bank of Nova Scotia, ticker BNS. The Canadian banks pay fat dividends, but do be sure you're aware of the tax implications of Canadian dividends for an American investor. It's nice to be a bank. Instead of putting your money in your Bank of America savings account, I'd say put that $100 in Bank of America stock. For the eighth pick, let's look at semiconductors, which have been a huge part of the technology revolution, and I would want to have some exposure to this industry. Some of the strongest dividend payers and growers are in this sector. I would pick one of either Texas Instruments, ticker TXN, or Broadcom, ticker AVGO. Texas Instruments with a 5-year dividend growth rate of 12%, and Broadcom with its 5-year dividend growth rate of 20% are both, in my opinion, the strongest in this sector. I actually own both. For pick number 9, I would go with one of the two main dividend telecoms. You have either AT&T T or Verizon VZ. These companies have been dead money in recent years and have lost a lot of value, but both do pay generous and slow-growing dividends. I think they're both due for a turnaround, and I would want to have some exposure for when that happens. And last but not least, for my final pick, I would put a real estate company for my last $100. And since I'm just starting out, I would want to go with Old Reliable Realty Income, ticker O. This is another one that I think most serious dividend investors do have some exposure to. This will be one of the higher dividend payers in the group, and it pays monthly, which is a sweet bonus. It's tough to beat getting paid every month by a company simply for holding their stock, right? Now, if you want to avoid real estate, maybe you already own some properties, then you can substitute that with the energy sector. And in this case, I would pick one of either Chevron, ticker CVX, or ExxonMobil, ticker XOM. They are the main players in that business, and their dividends are pretty safe. So I think this makes a good starter portfolio for your first $1,000 or whatever the amount is. And you could build these positions up via dollar cost averaging or load up on dips over time. Both of those strategies can be quite successful. The key is just to A, get started, and B, stick with it. There's that old Chinese proverb where the journey of 1,000 miles begins with a single step. You really just got to get started, and you just got to keep going. Dividend investing is not a get-rich-quick scheme. It is, in my opinion, a legit get-rich-slow plan, and that can be followed by anyone, regardless of their age or their income. So let's take a look at one of these sample portfolios. Let's take a look at how much dividend income we'd make off $1,000 with this sample starter portfolio. As usual, I have built out a spreadsheet to illustrate. I built this so that it spreads my initial investment equally across these 10 stocks. And by the way, it just so happens that I own all of these stocks, so it's not surprising that this is how I would build a portfolio today. With this, we have a dividend portfolio yielding just over 3%. So off this $1,000, you'd expect to collect just over $30 in dividend income throughout the next 12 months. And we could play around with this. Say the initial investment is $10,000, then we could expect to bring in about $304 in dividend income over the next year. That comes out to just over $25 a month. So already with a relatively small amount of money, we have a little bit of passive income, and based on the track record of these fine companies, we can expect all of these dividends to continue to grow year over year. Got $100,000 to start with? This setup would bring in about $3,039 over the next year, which comes out to over $250 a month. Now we're starting to see some serious money coming in every month, getting that snowball going. Obviously, the more money you start with, the easier the roll is. And ideally, you'll set this portfolio to automatically drip your dividends, which will accelerate the snowball process even further. Then going forward, add to the portfolio periodically as you can. Let's say we have $10,000 to start. We could buy $1,000 of each of these stocks. You'd have just over $300 in dividends coming in over the next year. Then for the next year, you commit to adding $100 per week to this portfolio. By the end of the year, you'd have invested $15,200 and you'd be expecting to collect about $461 in dividends for the next year. And actually, it would be a bit more because you'd have reinvested, about $350 of dividends during that first year. So it'd be closer to $472.54. And with dividend growth, I think you'd probably be closer to $500. Now, I'm not suggesting you go out and purchase this exactly. It's just an example starter portfolio meant to illustrate one way you could do it and be nicely diversified. Here is another way based on the stocks we discussed with some slightly different picks. Notice the yield came out about the same, with the only overlapping pick being J&J. Pretty cool. With this kind of thing, there's no real right or wrong way to do this. You gotta do what works for you, right? Now, thanks for watching, folks. There's more to come in the near future. Be sure you're following me on Twitter at DivGrowthIncome and feel free to say hello. And until next time, folks, keep investing.